The collapse of the mortgage-backed securities market and the investigation of Goldman Sachs, in fact, the lawsuit against Goldman Sachs, are different events, but they're connected events, and they will both produce similar outcomes for different reasons. The outcome are twofold. One is I think we'll see simpler securities going forward, and second, I think we'll see a smaller market for real estate lending going forward. Let's talk about why each of these will have those impacts. Why did the commercial mortgage-backed security market collapse in the first place? It's because people were buying something they didn't understand. Why were they willing to buy something they didn't understand? It's because commercial mortgage-backed securities had AAA ratings placed on them from rating agencies, Moody's, Standard & Poor's, Fitch. Investors, the iconic Norwegian pension fund, thought it could invest with confidence when it really didn't know what it was investing in because it relied on a third party, a rating agency, in order to do it. What they learned is the rating agencies didn't really understand the securities either. And they were buying stuff that was bad stuff. It was poorly underwritten loans on overvalued property, and ultimately the market collapsed. As a result of this, I think investors for some time will not rely on rating agencies to make investment decisions, but will actually have to make decisions based on whether they think an investment is good or not. For people to do that, they have to understand what they're investing in. And what that means is that securities are going to have to be simpler going forward. The second thing is, I think the market will be smaller because the market just got too big. And one of the reasons we had a collapse is because we had a boom. The size of the commercial lending market relative to the economy reached about twice its normal size in 2005 and 2006. So over the long run, what we'll see is a market that's more like normal, which is 50% of where it was a few years ago. One of the reasons for that is people didn't understand what they were investing in. They thought they could invest with confidence. If they know what they're investing in, they're going to invest less in that particular sector, but they will invest. Now, all this said, while the commercial mortgage-backed security essentially disappeared last year, I expect it to come back. It's a good instrument if it's structured correctly. It's an instrument that connects investors from all over the world with properties all over the world, and this is a good thing. This creates market efficiency. So let's now talk about the SEC action against Goldman Sachs. I think the most important implication of this is not for Goldman Sachs per se, although if you work at Goldman, you're going to care a lot about it, and if you're a shareholder with Goldman, you're going to care a lot about it, but rather that it makes financial reform much more likely to happen. And I think there are two aspects of financial reform that will have a powerful impact. And there are two things that are not getting very much commentary in the media, other than the specialized media. The first is, I think it more likely that securities going forward will be traded less over the counter and more on exchanges. And what this means is that people are going to know who they're doing business with. They're going to know who's on the other side of transactions. Right now, this is all kind of mysterious. And one of the reasons the SEC is suing Goldman Sachs is because they allege that it did not disclose to investors in a security that a notorious bear in the market was taking short positions in the security. Now, whether that's actionable or not is actually hard to say. But nevertheless, there was a lack of transparency between buyers and sellers of securities. I think the market will become more transparent. More transparent market is actually one where people are going to be more cautious about the investments that they make. The second thing is I think the days of highly levered large financial institutions are probably behind us. The idea that a financial institution that's too big to fail would be levered at 30 to 41 to 1 is now apparent to everyone as bad policy. This has implications for the real estate market because if institutions are not allowed to be as levered as they were before, there will be less capital available to lend to commercial real estate. This is not a bad thing. This is a more sustainable thing. But again, it does mean that the market will be smaller going forward.